Welcome for this session. This is Paresh Desai from Sankalp Ready Venture, and today we are going to see how is the equity as compared to futures and as compared to options. Okay, a lot of people have got this curiosity about futures and options. What is the future? What is a call? What is a put? What is the options? So we'll be understanding how the benefit is as compared to the equity, as compared to the futures, and as compared to the options. Okay. So equity, I'm sure everybody knows equity is when you buy the equity shares. जब इक्विटी शेयर्स खरीदते हैं तो आपका आप ओनर बन जाते हो कंपनी में, right? So when you buying an equity share, let us say I'm going to share the example here. If you are buying a stock which is, let us say, which is you can see in front of you here, which is of there was a buy signal somewhere here, okay, as per the technicals. So technical chart के हिसाब से यहाँ पर एक buy signal था. So I'm assuming कि somewhere around 1500 if you bought this share, and the current price is something like 1567. So percentage wise increase in is somewhere from what 1500 to here would be between 4.5%. Okay. So I'm just going to note this down in one place. Note करते हैं इसको. So first we're going to compare. The first one we're going to compare equity. Okay. So equity, what's happening is we are buying Reliance at rupees 1500 approximate. Okay. And then current market price. What was the date for Reliance? That was somewhere around, if you see the date was 12th of November. I put the date also. So that date was 12th November 2025. Current market price is 1567. Okay. So 1567 means basically till now there's a profit of 67%, 67 rupees. So return on investment, if you go for a formula, it is 67 upon 1500 into 100, it's coming to something like 4.5%. Okay, so from 12th November till today is what, 30th November? In approximately 20 days, we've got around 4.5% return. Okay, so this is as per the equity. Now let us understand what is the ROI once we come to something called as futures. I'll show the definition of a futures contract. Just give me a moment. So futures contract का definition ऐसा है. Futures contract is an agreement to buy or sell an asset at a future date at an agreed upon price. Okay. These are standardized agreements that typically trade on the exchanges. One party agrees to buy a given quantity and take delivery on the certain date. Both buyer and sellers are obligated to honor their commitment by buying or selling the underlying security or commodity on the expiry date of the contract. There are three contracts normally for an equity contract futures, which is going to be near month, mid month, and far month. Now, this is the definition. I'm sure most of you would not have understood much about this. Now, let us understand the context from something called as a forward contract. So, in forward contract, let us assume that there is a farmer who wants to grow, let us say, rice. He has just sown the rice, but his rice is not ready now. He's going to get the rice after, let us say, 3 months. Today's current market price of rice, let us say, is of that particular variety, 100 rupees per kg. Now, he does not know what is going to be the price after 3 months. It could be 100, it could be 110, it could be 90 rupees also. So if it is 100, it is okay. If it is 110, that is also fine. But what if the price goes to 90 rupees after 3 months? Then that is something which he would not like because he will be in a loss of 10 rupees. So what he would do is he would enter into something called as a forward contract with a wholesaler, and both of them agree that after 3 months, the crop, once it is ready, the farmer is going to sell it to the wholesaler. And the wholesaler will come and buy it after 3 months. And the date is fixed after 3 months. The quantity approximately is fixed and the rate is fixed. That's most important. Okay, so quantity, let us say if it is 1000 kgs, rate is approximately, let's say 100 rupees. So the total amount would come to around a lakh of rupees, right? But then the farmer says that I need some sort of security from you. You pay me a deposit, let us say 20%. So the wholesaler pays a deposit of 20,000 rupees to the farmer. And when the date of expiry, okay, when the crop is ready, he will come and pay the balance 80%. Okay. So that would be a understanding of what is the forward contract. Now, the futures contract is similar to this. In futures contract, if you are buying, let us say, Reliance futures, then right now you're just making a commitment to the seller. So if you are buying, then obviously there has to be somebody who's selling the Reliance shares to you in the futures. So futures, as we saw, the definition also, it is an organized contract. There is going to be a monitoring agency, which is the exchange. The quantity is fixed, which is called as a lot size. And both the buyer as well as seller, they have to commit their part of the commitment. Okay, so the seller also has to give 20% to the exchange. Buyer also has to give something like 20% to the exchange. Because at any point of time, either the buyer or seller is in loss, then that contract will be cut off and it will save the other person from the losses. So let us now understand how this particular thing would work in the futures. So I hope you understood the forward contract example of the farmer and the wholesaler. Similarly, now what we're having is that if you want to buy a Reliance futures, then let us understand how much money you're going to require. Now remember that the wholesaler paid only 20% to the farmer. He paid only 20,000 rupees to the farmer, right? So similarly, let us understand here from the Reliance futures contract that if you want to buy a Reliance futures, then what you need to do? So you just have to press your Reliance and say futures. Can you see you see December, January, February? There are three contracts which are available. Either you can buy a December expiry, January expiry, or February expiry. So let us see, go for the December expiry. Now, if you want to buy this particular contract, okay, the lot size is 500. Okay, and the price, if you see, is something like 1,577.90 rupees per share. So if you multiply 1577 into 500, how much is that going to be? Okay, so something like little less than approximately 8 lakh rupees, 7 lakh 80 or 7 lakh 90,000. That is going to be approximate full value if you pay. So if you have to buy 500 shares in equity, means buying actually the shares and keeping in your demat account 500 shares, it would cost you little less than 8 lakh rupees. But in futures, what happens is you don't pay 8 lakh rupees. Right now, you're paying only 1,40,000. Okay, can you see here required is saying 1,40,000. Okay. Now, assuming that you buy this futures contract, now let us understand how you'll benefit as a trader. Okay, so how you'll benefit this as a trader? Now, actually, now the price is 1577, but we have been thinking of buying when the price was at 1,500. So at 1,500, the price would have been something like the total value would have been 7 lakh 50, and the investment would have been slightly lesser. But I'm not taking a lesser investment amount also. I'm taking that let us say the required amount is 1,40,000. Okay, for one contract of Reliance futures of 500, which is called as a lot size. Now let us understand what happens. So now I'm comparing the futures with the equity. So if I take a Reliance futures, in Reliance futures, what would happen is we are buying at 1,500. Okay, the lot size is 500, and over here, what would happen is that the price has gone. This was the buying price. Current market price is 1,567. Your investment was not 500 into, let's say, 1,500, which is not 7 lakh 50. Your investment is just rupees 1,40,000. So now, how much rupees the price has gone up of Reliance? Reliance has gone up by 67 rupees. Okay, from 1,500 to 67 rupees. So profit is 67 rupees. Lot size is of 500. So total profit is how much? 67 into 500. So can I take something like approximately 33,500? So your profit is 33,500. Now, if you compare the ROI, return on your investment, okay, there is a scope where you don't have to wait till the end of the contract. At any point of time, you can exit. Unlike the contract with the forward contract with the farmer and wholesaler, here, if you buy a futures contract today, you can exit immediately same day also or after 2, 3 days also. You need not wait till the end of the contract. So let us assume that a person who has bought it at 1500, now he exits at 1567. So ROI is going to become how much? Your profit, which is 33,500. Your investment was how much? Not 7 lakh 50, but only this amount, which is 1 lakh 40,000. Approximately, this will come to 23 to 25%. Now compare the same thing with your ROI in equity. Your equity ROI was how much? 4.5%. What is your ROI on the futures? 25%. Yes, there is one cash over here that in futures, your minimum investment is going to be 1 lakh 40,000. Equity, you can buy one share also. Okay. But in futures, you have to buy minimum one lot, which is of 500 quantity. So your investment amount will increase. Okay. So I'll repeat one more time. In equity, you bought the shares, whether you buy one share or 500 shares, doesn't matter because your ROI is going to be the same, which is 4.5. Okay. Because ROI is something which is important. The absolute figure doesn't make any difference. It might be lakhs or crores or whatever. Ultimately, we have to see what is your return on investment in percentage basis, right? So if you're buying equity at a particular level when there was a breakout at let's say 1500, current market price 1567, so you got a profit of around 67 rupees and your ROI is 4.5%. Now this futures, we're comparing this with futures. Futures I told you is a contract which is going to be expiring, let's say in the end of the month. Every month end there's a contract. At any point there are 3 expiries. December, January, February. December is gone, then January, February, March. January goes, then February, March, April, and so on and so forth, right? So current expiry I'm taking, and current expiry, what happens is that you got ROI. If you bought it at 1500, the futures contract, you're not buying equity, you're buying futures contract at 1500. And once you buy at 1500, till date, the current MRP is current market price is around 1567. Your profit was 67 rupees. Lot size is 500. Total profit is 33,500. Your investment is just 1,40,000. So your ROI comes to 25%. Okay, so understanding futures is relatively simple. Why? Because instead of buying only equity, you bought one futures contract. Futures contract, only thing that the investment is going to be higher. It can be minimum 1 lakh, 1 lakh 50, can go to 2 lakhs, 3 lakhs also. So your investment amount is higher. You cannot buy one share in that. If you want to buy one share, 2 shares, 5 shares, 10 shares, you can go for the equity. So futures and options, first you have to understand that the amount required as investment is high. So 1,40,000 is called as the margin amount. Margin, why? Because the entire whole full value of the contract, which is approximately 1500 into 500, something like 7 lakh 50 to 8 lakh rupees. That is a full value. You don't have to pay the full value. You have to pay a margin, which is like a deposit. So approximately 15 to 20% is the amount of the deposit. And currently it is coming to around 1 lakh 40 or 1,40,000 approx, right? So it's relatively simple to understand that you pay only the margin amount, whatever is the profit, that profit you compare with the investment, and that's how you get your return on investment. Okay, so that is the second one. Now we're coming to the third and more, you can say, interesting concept, which is called of options. In options, there are two instruments. One is called as a call and one is called as a put. I'm just going to show you a matrix about what you can do with the call and the put. So call instrument and a put instrument. Okay, so if you go to the definition of a call instrument, if someone is buying a call, he is a bull. He is expecting the price to go up. He is expecting the price to go up. He will buy a call, right? And if he is a bear, he will buy a put. So call and put. Right now, I'm just going for the buy concept. I'm not going to the sell concept. We cannot take all the concepts at one time. So let us understand only the call part today, which is understanding that buying a call. So if you're if you are a bull, if you think that the price is going to go up, you'll buy a call. And if you think that the price is going to go down, you will buy a put. Now, what is a call and put? Basically, call and put, basically, they are the two instruments in the options. These are derivative segment. So the call instrument will give you a right to buy the underlying asset. Repeat again. The call instrument, if you're buying a call instrument, you're getting a right to buy the underlying asset at the strike price which you decide. When you buy a health insurance from an insurance company, what happens is that you enter into contract with the insurance company, and the insurance company says, listen, if something happens to you during this year, we will pay the hospital bills. Okay. And to ensure that, right, you pay us some premium. What is the word? Premium. So the policy amount might be possibly 10 lakh rupees, but the premium amount which you pay could be only possibly 20,000 or 25,000. Right. Now, similar over here, what happens in a call instrument is then when you're buying a call instrument, you're getting a right to buy the underlying asset at the strike price which you have selected. So if you have selected a strike price of 1500, you pay a particular premium. And if the price goes up, let us say 1600, 1700, if for example, right now the current price is 1567. And if the contract expires at 1567, then you still have got a right to buy Reliance Industries at 1500 because that was your strike price. I hope that you're getting this. If you select a particular strike prices will be in multiples, either 10 or 20. So if you buy a Reliance option, call option of 1500, you get a right to buy 500 shares of Reliance at 1500 on the date of expiry, irrespective of what is the current market price on expiry date. So on the expiry date, if the Reliance price is 1600, 1600, but you have entered into contract with the seller who said that I will give you 500 shares at 1500. And to get this particular right, you have paid him a premium. Okay, so that premium is not adjusted in the final price. Understand that premium is something which you're paying extra. That is for covering his risk. If the price goes up, then that's a risk on the seller's part, right? So that premium has to be paid to the insurer, to the seller, which is not going to be adjusted in the final price. But you still get to buy 500 shares at the strike price which you have selected. So now I'll just go and check out what are the strike price which is available. Now, let us come back to this matrix one more time. As I said, if you're buying a call instrument, you are a bull. For example, when the price of Reliance broke out of 1500, you are a bull. You are expecting that the price will go up. So you will buy a call. Exactly opposite if it happens, then you will buy a put. If you're expecting that the Reliance price will go down, then you would have bought a put. In put, you get a right to sell. When you're buying a put, you get a right to sell. So if the price comes down, then you get an advantage of the premium and you would end up in profit. If the price goes down and you already bought a put. If you bought a call and the price goes up, then as a buyer, you are at an advantage. Okay. So let us see what is the instrument which you could have bought for the options part. So I'm here going to, when the price was somewhere around 1500, there's an instrument called as 1500 CE of Reliance. So in Reliance, if I go to 1500 CE of Reliance, you can see what was the price on the day which we had decided that we want to buy that particular contract, was something like 12th of November. So on 12th November, this particular instrument, which is 1500 CE, was available at what price? 11th November. It is available somewhere around 40 rupees. 11th November. This is the date, 12th November. And on 12th November, it is available, let us say around 50 rupees. Okay, so I'm taking 50 rupees as a round figure. Okay, so just remember this figure, which is 50 rupees. Now, what has happened here? The price went up from 1500 to 1567 or 69, whatever, approximately 1570 rupees as of now. And what would be your ROI on options? What would be your investment and what would be your ROI in options? That is now let us understand. So now I'm coming to the option part. So in options, which is the third thing which I'm comparing, in options, you got we are buying 1500 CE of Reliance at a premium of how much? The premium which you're giving here is of 50 rupees. Okay, premium of 50 rupees. What is the lot size? Lot size is of 500. So the total premium which you pay would be something like 25,000. Now, as the price went up, okay, as the underlying asset went up, this is Reliance Industries, as the underlying asset went up, what happened was that the premium, which was 50 rupees, has now become how much? 80 rupees. Premium जो 50 rupees था, अभी 80 rupees हो गया है. Okay, so I marked these two lines. So from 50 rupees to 80 rupees, what is the change in the premium? Wow. Can you calculate the percentage basis? So when you come to the percentage basis, you'll understand that the percentage change is almost, we bought it at 50, now this will become 80 rupees. So your profit, total profit is equal to rupees 30. How did you get 30? 80 minus 50. What was your investment? Investment was 50 rupees, right? Investment was 50, which was the premium which you paid. And when you exited from the contract, you got back 80 rupees. You paid 50 rupees, and then you exited, you got back 80 rupees. So you made 30 rupees on a premium of 50 rupees. So ROI is 30 divided by 50. How much is that? That comes to 60%. So now can you understand the difference? Now let us again one more time understand all the three concepts. One which is equity. The equity price has moved only by 4.5%. Okay, that is pure equity. If you buy only equity, you'd have made a profit of 4.5% in the last 20-25 days. If somebody had bought a futures, then his ROI would be 25%. But again, here your minimum investment has to be at least 1,40,000. And then something more interesting, where the investment is also lower and the ROI is also very high. Reliance price went up from 1500 to 1567, 1570. The premium went up from 50 rupees to 80 rupees and you paid only 25,000, not even 1,40,000. So your amount of investment would be 25,000 and you made approximately 30 rupees into 50, 15,000 on 25,000. Then ROI becomes 60%. If you take per unit basis, it is going to be 30 and your investment was 50. So ROI is 60%. So with this, I hope you understood the comparison between the equity, futures, and options. So what we have done was related to options. We have taken as of now only understanding what is the call option, which you are going to take only when the prices increase. Okay, but for buying the call or deciding when to buy a call, when to buy a put, something called as technical analysis has to be very strong. If you want to have such large returns like 50%, 60%, 100% in a very short period, understand that your study has to be much more higher and has to have advanced indicators which will tell you where you'll have high probability setups. With this, I hope you got a basic idea of the futures and options. Although we have covered only the one part, which is of buying the call, the other concepts of buying a put, then selling a call, and also selling a put, which I'll try to take it in some other sessions. So if you like this video, do shower some love and do subscribe to this video and to this channel, and also do forward it to your friends. Thank you so much. See you again. Signing off. This is Paresh Desai from Sakar Pedi Venture. See you soon. Bye.